Most experts tell you that penny stocks are a trap, and honestly, most of the time they're right. The dream is looking in the bargain bin to unearth a hidden gem that soars higher. Too often, the reality is finding broken companies that show no signs of life. But every rule has exceptions, and today I'm going to show you 4 of them. These 4 stocks are all trading under $5 as of the week I'm recording, but they are not your average penny stocks. One of them just posted a surprisingly profitable quarter and popped on the news. Another is the single highest rated stock in its entire industry out of 50 competitors. And I'm going to save the best one for last. In this case, we have some top-rated Wall Street analysts pounding the table on serious upside potential ahead. But there is a catalyst here for shares hitting this month that many investors haven't even noticed yet. Now, if you're new to this channel, then let me introduce myself. I'm Steve Reitmeister, but all my friends call me Righty. I spent nearly 20 years as editor-in-chief of Zacks.com, where my commentary was read by millions of investors. And today I'm a partner at WallStreetZen, where our quant team analyzes the universe of stocks to find the ones most likely to beat the market. If you enjoy finding under-the-radar stocks, then do yourself a favor and tap that like button. It tells YouTube to send you more videos like this one in the future, so more hidden gem ideas land right in your feed. On that last thing, before we get started, remember, investing carries risk. You are responsible for your own decisions, so always do your own due diligence before buying or selling any stock. Let's kick off this list with a stock that has recently given investors a reason to pay serious attention. We're talking about Zedge with a symbol of ZDGE. They build content platforms for smartphone personalization, things like wallpapers, ringtones, creator tools, serving nearly 20 million monthly active users. Now, if you ever customize a look at your phone, then you probably use a product quite like this. It's a small company, the market cap of just 54 million, right? This is the kind of name most investors have never heard of, and that under-the-radar aspect is part of its appeal. So why is it on the stock list today? Because their most recent quarterly earnings report was a healthy beat on both the top and bottom line. And it wasn't a one-time fluke. It was the 3rd quarter in a row of beating earnings estimates. The reason is their shift to recurring, higher quality revenue. This shows up in the 32% increase in subscription revenue year over year. And here's something special about Zedge. The company is sitting on a hefty pile of cash relative to its small size, and it also carries very little debt, as proven by the modest debt-to-equity ratio of just 0.4. For a company this size, that's a fortress balance sheet. It means they can keep investing in growth whether a slow patch comes around, and they can buy back their shares without sweating the interest payments. They also recently raised their dividend by 25% and expanded their buyback program, which is exactly what you want to see from management that believes its own stock is undervalued. Now we turn to our best tool to analyze a small company like this with very little public research, and that's our coveted quant model, the Zen ratings. In all, we review 115 different fundamental factors for every stock to determine those most likely to outperform. In this case, Zedge ends up in the top 6% of all stocks, leading to a B rating. Note that only the top 5% of our stocks get the coveted A rating, so maybe it's a little more fair to say that Zedge is a B+++, all right? The overall Zen rating is built on 7 underlying component grades that let you see a stock's specific areas of strengths and weakness. Let's take a look at those right now. It shows up in the top 19% of all stocks for safety, which the model bases on things like price stability and cash flow and earnings consistency. It also ranks in the top 16% of stocks for sentiment, which tracks factors like institutional buying, analyst revisions, and insider activity. What stands out the most is the financials grade in the top 10% of all stocks. That lines up exactly with that solid balance sheet we just talked about and all that cash with almost no debt. So what about the risk? I'm going to level with you. Monthly active users actually slipped a little bit last quarter, and advertising revenue was soft, mostly tied to changes Google made to its search results. Management is choosing to manage that part of the business for profit rather than just chasing raw user numbers. That could turn out to be the right call, but it's worth knowing in advance. All in all, Zedge is not your average stock under $5 per share. They're a profitable company, riding a 3-quarter earning beat streak. Plus, they have very strong fundamentals, as proven by the Zen Ratings quant model that quite often points to stocks likely to outperform. That's a pretty good way to kick off this stock list today. Now, our second pick is something you don't see often at this price range, a profitable, high-margin software company. That brings us to VTEX with a symbol of VTEX. This company provides a software platform that powers online stores for big enterprise brands and retailers. Think of it as the engine running quietly behind the shopping experience. experience, letting major companies build their stores, manage orders across every channel, and run their own digital marketplaces. When you check out a large retailer site, there's a decent chance software like that from VTEX is doing the heavy lifting behind the scenes. What separates VTEX from a typical penny stock? Well, for one, it's a really profitable company. Their gross margins run above 78%, which is the kind of number you usually associate with an elite software business. The genius here is that once they built out the platform, then each new customer they add is very little in cost and very much to bottom line profits. Now, their operating margins recently hit record levels, a sign the business becoming more and more efficient as it scales. Even better, the PEG ratio of just 0.89 tells you that you're getting a very attractive price for all that growth. Many similar stocks are trading for 50 to 100% above that level. By the way, if you want to go deeper on how I read the market and find under the radar stocks like this, then you need to join my live weekly training sessions. They're totally free, include some of my top stock picks. Please join my next one this coming Monday at 7 p.m. Eastern Time. Just visit WallStreetZen.com/live to sign up now for free. Back to VTEX. The company has been executing at a very high level lately. They've notched 5 impressive earnings beats in a row, each showing ample year-over-year growth. A quarter or two, you could call that a fluke, but this is more and more like a business hitting its stride, true earnings momentum. One last thing before we move on to that fundamental profile. Wall Street's coverage is thin, but decidedly bullish. The good news is they keep hitting the ball out of the park during earnings season. They are likely to pick up more buy recommendations from the street, each one acting as a fresh catalyst to push shares higher. As we put VTEX under the microscope of the Zen ratings, it earns an elite A grade, with which amounts to a strong buy recommendation. In fact, they are in the top 1% of all stocks we track based upon their truly stellar fundamental profile. Its component grades are impressive as well, starting with a top 27% showing for value. Then as we go down, we find top 14% of all stocks for financials, followed by top 10% for growth. These latter two grades greatly increase the odds of more earnings beats ahead. But sentiment is the headline story. It ranks in the top 1% of all stocks we track. This tells us the smart money is circling around this stock. A risk to keep in mind with VTEX is geography. A big chunk of this business runs through Latin America, especially Brazil and Argentina. So currency swings and regional economic wobbles can show up in the reported numbers from quarter to quarter. That's the kind of trade-off that you accept with an emerging market platform. Here again, we have an under-the-radar penny stock, but don't let that obscure you from the fact that VTEX is a thriving high-margin software business the smart money is watching closely. Plus, that top 1% showing for the Zen ratings tells us we have a fundamentally sound firm likely to top the market in the months and years ahead. Hey, if you're getting value out of this video, then please hit subscribe and ring that notification bell. That's because I put out fresh breakdowns like this every single week, and subscribing is the best way to ensure you don't miss the next batch of stocks before they move higher. Now let's keep things moving with stock number 3, which is ATRenew with a symbol of RERE. This next one has a pretty interesting business model. ATRenew runs the leading platform in Japan for buying and reselling pre-owned electronics. Think of a trade-in. You bring in your old phone or laptop, they inspect it, refurbish it, and resell it to somebody else. With hundreds of millions of devices upgraded every year, it's a generally massive market opportunity in any country, let alone in China. And ATRenew has built the infrastructure to dominate, from collection points to automated quality inspection. As of this week, I'm recording the stock trades under 5 with a market cap around 420 million. Why is it exciting right now? Because the growth has been remarkable. In most recent quarter, ATRenew grew revenue more than 30% year over year. And here's the most important part. That top line strength is flowing through the bottom line as well. This shows up in 8 straight quarters of earnings beats. Plus, earnings are projected to rise 59% per year over the next 2 to 3 years. It will be a surprise to no one when I say the Zen ratings here is very strong. We're talking about a coveted A grade in the top 1% of all stocks we track. Even more impressive is the number 1 rated stock in the internet retail industry out of 30 companies in total, higher than Etsy, Chewy, and Wayfair. The component grades are also very strong, starting with the top 11% showing for value. Then as we drill down, we see it's top 6% of all stocks for growth, top 5% for sentiment. What's not to like about that? As a reminder, the Zen ratings are updated daily on our quote pages, so for the most up-to-date information, be sure to visit WallStreetZen.com. There are 2 areas of risk to note with this pick. ATRenew is a Chinese company trading on the U.S. markets. That brings the usual set of China-related risks, regulatory shifts in Beijing, and the broader oversight questions that hang over Chinese stocks listed on American exchanges. The stock has also pulled back nearly 30% over the past 3 months, so it's been quite volatile and you need to be able to stomach the ride. The other way to look at it is that right now you can get on board a fantastic growth stock in ATRenew at an even better price. Perhaps this online retail stock deserves a spot in your shopping cart. Before I get to my favorite pick on the list, I want to remind you about my free live trading session this coming Monday. These weekly sessions cover the gamut from my market outlook to my trading plan to outperform to my top stocks now. I just don't talk about what I'm buying, but how I'm finding them so you can do the same in the days ahead. I also unveil my trade of the week, combining the best of the Zen ratings with my greater than 40 years of investing experience. Now, if that sounds good to you, then join me this coming Monday at 7 p.m. Eastern Time. Just pause the video for a minute and register for free at WallStreetZen.com/live. You'll also find a link in the description or scan the QR code on your screen. I look forward to seeing you on Monday. All right, let's finish up the video strong with Taboola with a symbol of TBLA. This is the one I've been most excited about to share with you, and not just because the company name sounds like a character in a Dr. Seuss book. Taboola runs an AI-powered recommendation engine across the open web, the technology that suggests the next article or product you might want to look at as you browse around the internet. It works with thousands of publishers and reaches an enormous slice of the online world. No doubt you have used it many, many, many times before. And behind it is a $1.3 billion company that's becoming a real force in digital advertising. There are two good catalysts taking place right now, putting Taboola in the spotlight. First, they recently delivered a blowout earnings report. Analysts were modeling a small loss, and instead the company swung to a clear and strong profit. That's the second time this has happened in recent memory, and the third consecutive quarter with an impressive beat on the books. Here's the second catalyst, and it's something most investors are missing entirely. Taboola is being added to the Russell 2000 and Russell 3000 indexes at the close of trading on June 26. Here's why that matters. When a stock joins a major index, the funds that track those indices are essentially required to buy it. That can create real mechanical buying demand for the shares, the kind of demand that has nothing to do with whether the market is having a good day or not. Let's talk about what the Wall Street view is, because it's quite strong. Taboola carries a strong buy consensus among the top-rated analysts tracked on WallStreetZen.com, and the current fair value price targets point to over 40% upside in the coming year. That target might prove to be quite low, as the stock only has a peg of 0.5. That is dirt cheap relative to its growth prospects. Most tech peers trade for 2 to 3 times this level, which may better present the share price upside potential going forward. On top of that, Taboola earns a Zen rating of A, strong buy recommendation. That's because their fundamental profile scores in the top 1% of all stocks. Plus, it's in the top-rated internet content industry, where it's the #1 ranked stock out of 50, even higher than Google. Never a bad idea to go for the best stock in a top-rated industry. Let's dig deeper into those component grades, as we really have a hit parade of great scores. Top 15% all stocks for the consistency of growth. Top 8% for financial strength. Top 5% for value, which makes sense given what I just shared about the PEG ratio. And the cherry on top is the top 2% showing for the sentiment grade. This is a stellar quartet of strong scores that points to great investment setup. The potential downside is that digital advertising is a competitive arena, with giants like Google always in the mix. Also, their momentum score is only middle of the pack. But that fits in with our thesis of finding more under-the-radar opportunities likely to shine as more investors wake up to the growth and value story. The bottom line is that Taboola is the #1 stock in the highly rated internet content industry. Wall Street analysts are on board, as is the Zen ratings, where the fundamental profile scores in the top 1% of all stocks we review. On top of that, we have impressive value that points to ample upside potential ahead. So there you have it. 4 strong stocks trading under $5, not the usual junk that shows up in the penny stock bin. Instead, every one of them proves they have a special fundamental profile because they're top grades from the 115-factor review of the Zen ratings model. Most importantly is their top scores for growth and financial strength. I want to hear from you guys. Which of these 4 stocks do you like the most and you see has the most upside opportunity? And are there any other penny stocks you have your eye on that I didn't mention here that you think the rest of our audience should know about? Put it all in the comments section below. And if you're interested in exploring more under-the-radar opportunities, then take a look at the video popping up on your screen right now. In that one, I break down 4 stocks I'm watching the critical minerals sector ready to run higher thanks to the next global boom.